quick little informational piece about the stock market from someone who's not in the stock market. And what I mean by that is I, like everybody else, have just bought stocks here and there without really having a broad base of knowledge about the stock market. So I put together a bunch of basic things I think most people should know before they buy any stocks or get involved in the stock market. There's a little more than just buying low and selling high when it comes to stocks. There are different type of market conditions in which you could be involved in. One would be the bear markets. Bear markets are markets headed towards a downward trend. Sometimes people who are in the stock market for long periods of time will figure out that they could sell or sell short in a bear market in an attempt to realize profit. Sometimes people will try to guess where the bottom is and then try to ride the stock back up. Now in a bull markets are considered higher performing markets, and people buy stocks in the hope that they will keep going up in a bull market. Usually you can realize a lot more profitability if you don't know anything about the stock market in a bull market, because companies are usually doing better than normal. The most important thing to remember in both markets is this: there's plenty of room for bears, there's plenty of room for bulls, but there's no room for pigs. And what we usually mean by that is getting greedy in any market can lead to financial disaster. So whether you're in a bull market or a bear market, you could play that market and still realize some profit, make some dividends. But if you start getting too greedy, there's a chance you could lose a lot of money. So before you buy any stock, you should know where you're buying your stock from. There's two main U.S. exchanges where you want to buy your stocks from. One is the NYSE, which is the New York Stock Exchange, and the other is the NASDAQ, which is the National Association of Security Dealers and Automated Quotations. And each exchange will carry different stocks for different reasons. And as you do your homework, you'll find out why they're there and which ones you might be interested in purchasing. If you have an online trading account, or any account for that matter, you're going to see two words. You're going to see bid and ask. The bid is the highest price a potential buyer will pay for a stock that is listed on the exchange. The ask is the lowest price a potential seller will take for that stock that's listed on the exchange. And the spread is the space in between the bid and the ask. Without getting too technical, there's going to be two types of stock that you're going to want to purchase. You're either going to purchase preferred stock or common stock. Now, there is a little bit of a difference. Preferred stock is a steady and predictable income-based stock for the most part, but there's no voting rights, but you are first in line of any common stock holder for payments in the event of a liquidation. Now, common stockholders have voting rights, they usually get dividends, and they have some ownership claims. But remember, they're going to get paid after the preferred stockholders. So depending upon why you're buying your stock, if you're buying it for dividend income, you're not going to want preferred stock. You're going to hold on to common stock. If you're buying it because you want to be the first one to get paid out in the event of a liquidation, and you might have more value in your stock, then you might want preferred stock. Now, the ways to buy stock are a little more technical. There's the basic limit order. You set the price you want to pay for a stock. If that price isn't met, you don't buy. So if I want to buy a stock at $8 a share and it's at $9.25, I'll put in a limit order to buy at $8 a share. If at any point in the day that number for that stock reaches $8 or lower than $8, I'm going to automatically buy at $8 a share. Then you have a market order. Let's say you want this stock no matter what. So you put in a market order. Whatever the market price is at the minute you execute that order is the price you'll pay for that stock if there's shares on the open market. Then you have something called a margin. This is a loan against your account. If this margin goes down, the broker may sell other securities to cover your losses. That's called a market call. This allows you to borrow money to buy stock, which is highly risky, but you can borrow a percentage of what's in your account or against stock you already have as value. But in the event of a downturn, they will liquidate your portfolio to get their money. Then you're going to see something called a fill or kill. People use this term sometimes if they put in for a large amount or even a small amount of stock. So if I want to buy 100 shares of stock and I don't have a fill or kill order, what will happen is this. Let's say I get a partial fill notice. That means the computer will execute my purchase, but it'll say 50 shares purchased. So it'll execute half if it can, or 3/4, or a full, but might be 2 partial orders throughout the day. A fill or kill means this. I want 100 shares or 1,000 shares or 1,000,000 shares, but I want them in one purchase. If it doesn't happen, you kill that order. You don't partially fill it. You might hear people talk about something called an IPO or an initial public offering, and you might want to get involved in this. People will tell you all the times IPOs make money, and they do. But You're getting in on the ground floor of a stock that a company that was once private is now offering stock to the public. However, if you purchase this as an IPO or a pre-sale stock, there are lots of things you have to understand. They're usually available to institutional investors, company insiders, certain income or asset requirements. It's not traditionally open to retail investors, which would be the average person buying some shares. The day it opens, it is, but prior to that, it's not. Now, you don't get to buy and sell immediately sometimes. You have to get clearance. These are usually restricted stocks. So let's say you get on the ground floor of a stock that opens at $7 or $10 a share. It might hit $200 by the end of the day, but you won't have access to selling that stock until the SEC clears your restrictions. And that could take weeks, it could take months, it could take up to a year. It all depends on how the purchase is structured. Now, the good thing about it, let's say you bought a stock that was $7 or $10 a share, and it's locked up in the company's equity at this moment until it gets cleared. It may hit 100 or 200 and then bounce down to 50 or 30. But in most cases, if it was a quality stock and you bought in early enough, even if a $200 run settles somewhere around $30 a share, you probably have a lower purchase price. So once your stock restriction is lifted, you'll have plenty of time to execute a sale order and pull some money out. Here's a dangerous thing I don't recommend anyone doing, myself included, unless you know something about how this works. You will hear about things called short sales or selling short, and this means you're selling a stock instead of buying it. So if you believe that a stock, for whatever reason, is going to tank or go down significantly, instead of buying shares and riding them down and losing money, you're going to put in a sell order, let's say at $10 a share. And by the end of the day, if that stock hits $8 a share, you're going to buy it back. So what you did was you bought it at 8, you sold it at 10, you picked up what's in the middle, which in this case would be $2 a share. Now, putting an order in to sell a stock means you're betting on it's going down. In this case, you sell at a high number and you try to buy it back at a low number. Here's the problem though. If you have a short sale, there's no ceiling for a short sale. So what I mean by that is this. If you buy a stock and lose money, it could go down to zero. Once it goes down to zero, you're done. You're out of money. However, short sales continue to go up because you're riding the sales upwards, not downwards. They have no cap. A stock could be $10 today and be $200 in an hour, which means you would owe $190 a share. And it could go to 500 or 1,000 or 10,000. There's no zero on the ceiling. So if you don't buy back before the stock runs straight up, you're responsible for every dollar with no zero to stop your losses. Now we're going to talk about something called day trading. You hear people talk about day trading all the time. Once people were able to buy stocks on their own computer, everybody thought they were going to be $1 million day trader. Day trading has a very high potential for loss. All right, it's potential for very high risk situations that you may or may not be considering when you buy and sell your stock. So buying or selling stocks within a 24-hour period is an attempt to make money within a trading day. This is a high risk and it has very high tax implications because if you don't wait out the stock, you're going to pay higher capital gains. Now, there are people who make tons of money day trading. For example, there was a stock that was recently on the market. It opened at $16 a share. And at the end of day one, closed at $253. Now, by day 4, it was back down to $40 or $30 a share, where it should have really been. That was its real value. But in that day, if a couple of people bought 10, 20, 30,000 shares and rode it up to 200 and then sold it on the way down or sold it short, they made millions of dollars. The average person is really not geared towards that. And they don't have the time to sit in front of a computer and watch all these charts. And without knowing anything about the company or what the market volatility is, there's going to be a real problem. So if it's not your business, you want to try it. I know people that do. But personally, I don't recommend doing it unless you know exactly what you're doing. Now we're going to talk about something that you might do with your portfolio. Let's say you had a 401k, or let's say you had some money invested in a stock that you like, and you don't plan on selling it out soon. I won't even use any stock as an example because I'm not going to promote any stock one way or another. I'm not a broker. It's not what I do. But let's talk about dollar cost averaging. You buy the same stock over time with the same amount of money in consistent intervals, regardless of the stock price. What I mean by that is you purchase a stock, it's $10 a share. Tomorrow it's $8 a share. In a month, it's $6 a share. 5 months from now, it's $12 a share. It doesn't matter. Let's say you pick a date, August 15th. Every August 15th, you buy $1,000 worth of this stock, and you do it consistently for years. You're going to get what's called a dollar cost average. So you might pay $8, $6, $10, $12, but over the lifetime of the stock, you might average $12 a share, and when you finally cash it out, it might be $24 a share, and you're going to make money. The other technique is called averaging down. You buy more shares as the price drops in the hopes of averaging out the overall cost of all the stock purchased. So you take a company that you know is a major corporation, in your mind you think they're not going to go anywhere, but we have a market downturn. So we change presidents, or we have an inflation issue, or there's a war, whatever it is, changes the market. But you say, you know what, I'm going to buy this car company. This car company's been around for 100 years. They're not going to go anywhere. So all of a sudden, you own some, then the stock dips. So you say, you know what, I'm going to buy some more at a lower price. And you do it a couple of times. And then your price might have been $10, $12, $6. So you add that up, you divide it by 3, and that's really the average of what it's costing you for all your stock. And then hopefully you can ride it back up, or in a few years, you'll make back in dividends, whatever it is your plan is, but that's the difference. So there's dollar cost averaging, and then there's averaging down. Now we're going to talk about a term you may have heard called splits. When a stock splits, is this good or is this bad? Well, the answer to that question is yes. When a company wants to lower the price and release more shares into the market, a stock can split. So let's say you had a $400 stock. If for whatever reason, the company does not want a $400 stock. They don't want to appeal to that kind of investor. They want to appeal to a smaller investor with a little more capital that they could play with. They might split their stock 4-1. And what that means is if you already own the stock at $200 a share, you're going to get 4 $50 stocks. But now, when that stock is on the market, it's only selling at $50 a share. So someone like me or someone like you might say, I can spend $50 a share. I'm not going to spend $200 a share. Now you're going to get 1 share for that $50. Now let's say that stock rides up again to 200. Well, now you're an owner of 1 share and it's worth 200. So if it splits again, now you're going to get 4 shares. So you should have the same value. You'll just have more stock. And then as it goes up, you'll increase your value per stock. Now we have the reverse split, which is usually not a good thing. What this means is the company reverses the number of shares outstanding to raise the stock price. Now, I have had stocks where I had 1,000 shares at $3 a share. And I said, wow, if I could ride this up to 30 or 40, I'm going to make real money. And then that company issued a reverse split, which means what they did was they said to me, okay, you have 1,000 shares. Now you have 250 shares. And we raised the price to $12. Now, if that stock goes down, I'm losing money. If it goes up, I'm not necessarily making more money. So reverse splits are not really a good thing for an investor who already owns the stock. So you got to watch that. If it does happen, sometimes they turn it around and you can ride that back up, but it might take a lot longer. I would rather have my stock split than reverse split. Now we're going to talk about some income and some taxes. Companies that decide to pay their shareholders will pay a percentage of their profits at a given time, usually quarterly, in the form of a small amount of money per share called a dividend. Now, there's a couple of ways you can take that money. You can take that money outright, where they will write you a check or deposit the money directly into your account, or you can go into something called the DRIP. The DRIP is the Dividend Reinvestment Program. Now, even though you're still responsible for the tax on the money as if it were an income, what will happen is your stockbroker will be alerted to the fact that your money is going to go back into stock. So you're actually buying more of the same stock with the dividend money they're giving you. What this does is this allows you to own more of the company from the money they're paying you. So if you get a dividend of 15 cents a share or 20 cents a share or $1 a share, whatever it is, you're going to get that percentage in stock in your account. Now, over 20 or 30 years, you might be able to ride your stock really high up. Plus, it's also a good way to cost average. Now we're going to talk about the money piece. When you make that money, whatever it is, or when you sell your stock, you're going to have to pay something called capital gains. Capital gains is money that is paid to you as a result of a stock sale, usually in the excess of the purchase price. If it's below that, it's called a loss. Both carry tax implications, and both are forms of income. So whether it's dividend reinvestment or initial capital gains on your money that you made, they're both going to have some type of tax implication. Now, all your tax implications are time sensitive, which means however long you hold a stock is going to determine how much tax you might have to pay. And there's one other thing that you want to look at is if you sell too much of your stock and you don't have any loss to write off against it, you're going to pay the full amount of taxes on your stocks. So some people like to take a couple of losses, sell that off. I think you can deduct up to $3,000 a year. I'm not sure on that number 100%. Remember, your losses are capped, but the amount of money you make, you pay tax on is infinite. However much money you make, that's how much you pay tax on. So those are two things that are important. So remember, if you have some money to invest and you want to invest it and you try to do it on your own, do your research. Do a lot of research. If you don't do a lot of research, you're going to need a broker. And brokers charge you for their insight. But if you have a financial planner or you have a broker, it might be worth it to talk to them before you go buying anything. Now, if you see a stock that's been around for a long time, you want to take a chance on it, you decide to buy it, then you can buy and sell that whenever you want with your own account. And you can open online accounts all the time. You can open with brokerage firms and have them manage them. So you have a lot of options when it comes to this. Just be careful with what you do and be careful how you spend your money.